And then what does it break?
Good morning, everybody. Hope you're enjoying your breakfast. Feel free to grab seconds if you need another piece of bacon to get your day started. We're going to go ahead and get started. We have a lot of information to get through, and so want to make sure that we have enough time for that, and then there will be an opportunity for questions at the end as well, so we want to make sure we have enough time for that. So I'm Charlotte Robinson. I'm the president of the Thunder Bay Chamber of Commerce. Thrilled to have such a great turnout to the event today. We begin acknowledging that the City of Thunder Bay is built on the traditional lands of the Anishinaabe peoples of Fort William First Nation, original signatories to the Robinson-Superior Treaty of 1850. We recognize the significant contributions of the First Nations, Inuit, and Métis peoples to our heritage, social, cultural, spiritual, and economic wealth. The Chamber is committed to a relationship with First Nations, Métis, and Inuit peoples that is grounded on the principles of trust, respect, reciprocity, and collaboration in a spirit of reconciliation. I would like to acknowledge we have Councillor Rajni Agarwal with us this morning. Thanks for being here, Rajni. Appreciate that. And I want to thank our two sponsors of the breakfast this morning, BDO Canada and MMP, for their support for this event. So let's give them a quick round of applause. So the reason we're all here today stems from the federal budget and various changes to the capital gains taxation. While the government narrative suggests that this will only impact a very small number of wealthy Canadians, the fact is that 1 in 5 Canadian companies are likely to be directly impacted over the next 10 years. With that in mind, we at the Chamber wanted to help you, our members, to better understand the impacts to you and to your business. So I called Rob Mozon at MMP and Blair Smith at BDO Canada to ask for their assistance. And they gladly volunteered their colleagues for the task. So I'm really thrilled to introduce our speakers today, David Fitzpatrick, CPA CA partner with Taxation Services at MMP LLP, and Jennifer Whalen, CPA CA partner with BDO Canada. And David's going to kick it off and then hand it over to Jennifer. So David, over to you. It's right there.
Good morning, everybody. There we go. Okay, so today we're going to talk about some of the summary of the proposed changes and what that impact's going to be on individuals and corporations. I'm going to go through a couple examples. They will be a little bit technical, but the important part is kind of the end result. And then we're going to talk about some areas of uncertainty and what you should be doing or what you should be thinking about in the next couple weeks before the June 25th date. So what we know is they proposed to increase the capital gains inclusion rate from 1/2 to 2/3, and this would be on any gains on June 25th or after, and it only applies to a portion of capital gains realized after $250,000. So the first $250,000 of capital gains realized would be under the old 50%.
We're going to turn your mic up a bit. We can't hear you quite so well at the back. So just let John switch in there and turn you up a touch.
So the first 250,000 would still be under the old 50% inclusion rate. So what does that mean for individuals right now? So this is at the highest personal marginal tax rate. So right now, before June 25th, there's the highest marginal tax rate on capital gains is 26.76%. If you increase the inclusion rate to the 2/3, that means the new highest marginal tax rate will be 35.69%. So that's a difference of 8.94% of additional taxes on capital gains over and above the 250,000 rate. So for corporations, the same rules apply. It's going to increase the inclusion rate to 2/3 from 1/2. So if you have a capital gain, 2/3 of that's going to be taxable. There is no $250,000 threshold amount. So if you're a corporation and you have a capital gain, that's automatically at the new two-third inclusion rates. And there's gonna be some transitional rules. So if you have a year end that is on or after June 25th, and there's gonna be two inclusion rates, any capital gains realized prior to June 25th, like individuals, will have the old rules of the 50%, and any capital gain after that date will have the new two-third inclusion rates. So again, I'm gonna go through a couple examples. It might be a little bit technical, but the important part is kind of the ending. And so I'm comparing a personal capital gain with a corporation, and we all know that for personal taxes, you're taxed at your marginal tax rates. So the more income you have, the higher your tax rate's gonna be, and that's gonna once you hit the top marginal rate is 53.53%. For corporations, any active income is taxed at the small business rate, which is about 12.2%. Anything over $500,000 in a corporation is taxed at the general rate. For investment income, what some people don't realize that investment income in a corporation is taxed differently. And what the government's trying to make sure what happens is that if you own investments personally or in a corporation, it's taxed at the same rate. This is called integration. There's certain mechanisms in the tax system that allow for this. However, with tax rates always changing, integration's never perfect. So there's usually one side that benefits. So if we run through a couple examples, this would be realizing a capital gain personally and through corporation. So this is what the current system is prior to these changes on June 25th. So if you have a capital gain, 50% less taxable, this would be a personal, the individual. The tax rate is 53.53%. So your taxes on the $50,000 taxable capital gain is $26,765. So at the end of the day, if you have a $100,000 capital gain, you pay your taxes, you're left with $73,235 in your pocket that you could use for whatever you need. For a corporation, in this scenario, what I'm saying is you're a corporation, you wanna realize a $100,000 capital gain, you wanna draw out all the money and use it for personal use. So in order to do so, you have to realize the capital gain in the corporation. 50% of that is taxable, so you have a $50,000 taxable capital gain. The tax rate for investment income in corporation is 50.17, so that leaves you taxes of $25,085. Of that $50,000, however, 30.6% of the taxable income is refundable to you as long as you pay out a personal dividend and pay tax on that. Also, the 50% of the capital gain that's non-taxable, that can be paid out to you as a capital dividend, a tax-free distribution from the corporation. So in this scenario, if you have realized $100,000 capital gain, you pay your corporate taxes of $9,752. You pay out the non-taxable portion of the capital gain, $50,000. You're left with $40,248 that you would have to take out of the corporation as a taxable dividend. The taxes on that taxable dividend are $19,215. So at the end of the day, in this corporate scenario, you're left with $71,034 in your pocket. So right now, with the current tax system, you're better off holding investments personally by about 2.2%. So that is where we are right now. So this is the direct impact of the proposed changes to corporations. This should say pre-June 25th and June 25th and onward, but right now the pre-June 25th is the exact same scenario that I just went through, where you're left with $71,034 in your pocket. Now, if we increase that inclusion rate to 2/3 and go through that example, you'll see now that the taxable portion of the capital gain is $66,670. So the tax in the corporation's gone up by $8,363. There's more refundable portion now, but the overall net tax, if you pay out everything under the corporation, you have $13,003. $13,003 is the tax, so that's gone up by about $3,251. Because now 2/3 of the capital gain is taxable, there's only 1/3 that's non-taxable, and that 1/3 is the amount that can be paid out as a tax-free distribution. So that leaves you with an amount of $53,667 that would have to be paid out as a taxable dividend. And the taxes on that are $25,621. So now you're left with $61,376. So with this increase in the inclusion rate, you are worse off or paying 9.66% more tax if you realize a capital gain, draw the money out and use it for personal use. So that is the cost of the tax when you increase the inclusion rate. The other factor that you have to take into consideration is a couple of years ago they introduced rules around aggregate investment income. So at the bottom you'll see there's AAII of 16,000, additional AAII of 16,660. So for the first once you hit $50,000 of investment income, any dollar over that will grind down your small business deduction limit by $5. So this 16,670, if you multiply that by 5, I believe that's around 83,000, and then you multiply it by the federal small business deduction rate, that's about $5,000, 6%, so it's about $5,000. So it's potential that in the next fiscal year, your small business deduction limit will be ground down, and it'll cost you another $5,000. That would be dependent on the income that you are earning in your corporation and the amount of income, but it is possible that this will also grind down your small business deduction rate as well. So now we'll just look at an overall comparison. So if you're less than $250,000 of taxable capital gains in your individual, we've already gone through the scenario. You pay your taxes, you're left with that $73,235. If you have if you're over $250,000, you're into the new 2/3 inclusion rate. So for an individual, you're on $66,670 is taxable. The tax on that's $35,688, and now you're left with $64,312 in your pocket at the end of the day. And this is the corporate example that we just went through with the new 2/3 inclusion rate, and you're left with the $61,376. So if you take the difference between a corporation and an individual when they have less than $250,000 of capital gains, you can see that their difference is about 11.9% now, where you're better off holding an investment personally than you are with a corporation. If you compare it to capital gains when you're over 250,000, you're around that 2.9%. And then the biggest takeaway from here is the decrease for an individual. You're paying, in this case, $8,923 more taxes, so about 8.9% more taxes on that capital gain that you are realizing if it is over $250,000. That's going to be the cost. So some other areas or considerations that we have to take in account. Number one is there is no draft legislation available at this point. So they introduce this, but we don't know what the legislation is actually going to look like. This is just based on the information that we currently have available to us. There are other legislations that will impact some of your planning, such as AMT or GAR. They have not been enacted, but we know what they are. So a lot of people will kind of go through some talking points in the next slide, but realizing capital gains before this new inclusion rate could create some additional taxes that you should consider before you just automatically go into realizing capital gains. Any net capital losses you had in prior years will be appropriately adjusted for the new inclusion rate. There is no grandfathering of unrealized gains pre-June 25th. And and the $250,000 threshold, it applies to net capital losses and lifetime capital gains. So what I'm trying to say here is if you have $300,000 of capital gains and also $100,000 of capital losses in the same year, you net them together, and if it's not over $250,000, you're in the 50% inclusion rate, and if you're over that amount, then you are in the new inclusion rate. So it's not $500,000 of capital gains, $200,000 of capital losses. and you're into the 2/3 inclusion rate. So what are things that you should do or think about doing? So I've had a lot of clients reach out to me and wonder if they should just crystallize their accrued gains in their portfolios prior to June 25th to realize the 50% inclusion rate. There's a lot of specific facts that you have to think about when you want to do that. The biggest one is the tax saving versus the opportunity cost. So if you use my example of that $100,000, if you were just to leave that $100,000 in the market and grow, it will grow at a rate of return. I don't know what that's going to be. You'll have to figure out kind of what that number would be. Or you could realize that, have less money, you'd only have that $73,000, that would be in the market, and that would be the amount that would be growing. So you have less money available to you to grow, so is it worth paying the taxes now or saving that money, keeping it in the market and allowing it to grow? So there's really certain considerations that you have to take into consideration when you're thinking about if you want to crystallize capital gains. What I have been telling most clients is, if you're in a situation where you know 100%, doesn't matter what the change in inclusion rate is, you're going to be realizing a capital gain, then it probably makes sense to do it before June 25th. It doesn't always, but it probably does. For example, I had a client who was selling a rental property, so they weren't utilizing their principal residence exemption, and the closing date was July 5th. So we got him to change that to June 25th, so that he is going to definitely be under the new the old 50% inclusion rate on that sale of the rental property. So situations like that where you know no matter what, if you're going to be selling something, then it would make sense to try to do it pre-June 25th. But if you're just trying to do something to get around rules or change, you need to kind of consider all the different tax scenarios. The other thing would be you have to have the cash on hand to pay taxes. I know a lot of people have been discussing transferring properties to their either their children or their grandchildren. If you want to do that, there's no problem with that, but you need to realize that when you're doing that and you're gifting to them, there's no consideration coming in, and it could be a significant tax liability that's created, and you need to have the cash in order to pay that tax liability. So considerations like that need to be taken into consideration. And then also the other thing is you need to think about the impact of the new AMT rules. So what AMT is it's a tax calculation that basically runs parallel to your regular tax calculation, and whatever tax is typically higher is the one that you pay. AMT doesn't have as much preferred tax treatment, so anytime you usually utilize your lifetime capital gains exemption, with the new rules that haven't been enacted yet, capital gains would likely get caught under AMT. So what I'm saying here is that you might have a scenario where you've looked at it and you think it makes sense for you to crystallize or realize a lot of capital gains. You know what the taxes are going to be, and you're comfortable with that, and then so you realize your capital gains, and then you come tax time, you have the cash ready for the tax payment, and when you file your taxes, you realize that it's $40,000 more than you originally thought it would be. That $40,000 more would likely be this AMT tax. So that's a consideration. And again, we know what the rules are, but they haven't been enacted. We don't know when they're going to be enacted. So that is another consideration that you need to think of before you just crystallize or realize capital gains. And for corporations, as I mentioned, if you are over $50,000 of investment income in your corporation, this may impact your small business deduction limit for the next year. It may ground that down. If you have $150,000 of investment income, that could ground your small business deduction limit down in the next year to 0. So you may not be able to utilize the federal portion of the small business deduction. So again, it's not just thinking about, okay, I'm going to realize these capital gains. There's a lot of considerations that you have to think about, and you have to go through before you make that decision. And at the same time, what I'm saying here is sometimes accelerating gains doesn't always make sense. So if you have a business and you're going to utilize the lifetime capital gains exemption, it's proposed that on June 25th, the small business, or the lifetime capital gains exemption is moving up from, I believe it's $1,016,000 to $1.25 million. So it may make sense to wait till after June 25th and utilize more of the lifetime capital gains exemption depending on the sale price of the sale of your business. So again, accelerating sales also doesn't always make sense. You have to look at everything involved before you make any type of decision on that. So as I mentioned, it is right now at this time likely better to hold your investments personally than it is for your corporation, just because of the different tax rates. You could take advantage of the $250,000 threshold for capital gains. There's no grind down on your small business deduction if you are a corporate, if you own the investments personally. However, there would be an impact on transferring if you had investments in your corporation and you transfer them to yourself as an individual. There's going to be a lot of tax consequences and a lot of other things that would impact that decision. So again, although it likely makes sense to do that from a strict tax perspective, you need to look at all the other considerations before you just jump in and try to do something like that. So this is really the what to do. It's right now is revisiting your estate plan, reviewing options for taxable versus non-taxable transfers. Again, implications on your cottage or investment properties. You need to take in consideration AMT, revisit wills if you're transferring assets, taking a look at those and seeing what assets are going where, and what the tax implications are of those transfers, and also revisiting life insurance coverage. One insurance may be more, maybe something that's more attractive now because there's not as much, the income earned on that isn't typically taxed. You may also want to revisit life insurance because there's going to be additional taxes, so you might have a life insurance in place, and now you want to make sure that that life insurance that eventually is going to come in is going to cover your taxes upon eventual death. So just revisiting insurance coverage, talking to your insurance agents, and making sure that you are properly covered. So again, every case that you have is very fact specific, and there's no one size fits all. So if you are looking at doing something, it's very important to talk to advisors as soon as possible, and make sure that they know your situation, and then they can explain to you exactly what where you are and what options you may have. Yeah, very fact specific. And also time is of the essence, unfortunately, because June 15th is the effective date for all this to change. So that does not give you a ton of time to put any plans in place. Obviously, selling a business, selling assets, selling a property, that could be quite time consuming, and it will take time for everyone involved to get everything completed prior to June 25th. So the sooner you could start looking at these things would be the better for you. Okay, so now Jen is going to go through some the Canadian entrepreneurial incentives.
Good morning, everyone. So the other major change in the budget was a new program called the Canadian Entrepreneur Incentive. It kind of came as a surprise to us because no one was really asking for another program, and no one really knows where the idea came from. So before that, this is kind of the agenda of what I'm going to talk about, because before I jump into this new program, I want to kind of explain the history of what we have for people, what options people have for starting a business, what they've had in the past, what they had 2 years ago, and what they'll have next year. So in the past, before 2022, there was 2 different options for selling your business, right? I mean, they're still the same options, but different tax consequences. You could sell your business to a third party. You could sell it to me. I could incorporate a company. You could claim the lifetime capital gains exemption and realize more money for yourself. I could arrange my affairs, so if I had to borrow money, I could have that in the corporation. I would pay a lot less interest, a lot less tax as a third party buying your business. You'd end up with more money. I'd end up with less tax costs, less interest costs, and it worked pretty well. If you took that same transaction and tried to have it with a related person, like your child, your grandchild, your brother, your sister, your mom, your dad, you couldn't do that. You would have to have that person earn money, pay personal tax, and then buy your business. So it was a lot more expensive to do that. So the government realized for years that it was kind of not really fair, because a lot of people would like to sell their businesses to the next generation. But they didn't really know how to address that without opening it up to all kinds of schemes and loopholes that people would realize on the side. But a private member in 2022 put forward a bill that said this is not fair. Even though the government can't figure out a way to fix it, you still have to allow people to do this with the next generation. And that bill passed in 2022, and we refer to it as Bill C-208. So for 2022 and 2023, we were implementing a lot of those transactions. Before that, all we really could do was take that, the person that wanted to sell the next generation, take their common shares that were maybe worth $1 million, exchange them for a fixed value preferred for $1 million, and over time we would redeem those shares over 5, 10, 15 years, and they'd pay dividends tax on those. You wouldn't get the lifetime capital gains exemption, but you'd pay dividend tax. And it wasn't terrible. I mean, back in 2012, if you go back a few years, the dividend tax was 34%. So you weren't paying the 26% capital gains tax, you were paying 34% dividend tax. Not terrible, not ideal, but not terrible. Well, the dividend tax rate now is 47%. So it's a major difference. So people, it was over the time, the tax cost for those oil plants just became more and more expensive. And the lifetime capital gains exemption, so why is that so important? It started in 1985, before I was in tax. But I have been around to see the capital gains inclusion rate change 3 or 4 times now. I've been around since 1994, where they took the capital gains rates of election away. But this started in 1985, and originally it was supposed to apply to everything. So whatever asset you sold, whether it was a rental property, shares of the Royal Bank, or your small business, was supposed to be a $500,000 exemption for everything. And the government quickly took that away and made it $100,000 for everything, and then they took that away in 1994 as well. So the lifetime capital gains exemption really only applies to people that are selling their small business that qualify. So it started off at $500,000. It's kind of gradually increased over the years to now $1,016,000 for this year, and they've proposed to increase it to 1.25 for 2024. So if you combine the increase with the change in the capital gains inclusion rates that Dave was just talking about, and this new bump up in the capital gains, the lifetime capital gains exemption, your savings could go from the $250,000, which on $1 million, to $416,000 on the new amount. So it's a pretty big savings for after June 25th. And then they say after 2025, they're going to index that to inflation, so that amount will just keep growing at a hopefully small percentage every single year. It really comes into play if you have a family trust. If you are one of the lucky people that have a family trust on your business, you could take that lifetime capital gains exemption and multiply it by all the beneficiaries of your family trust. So if you had a family trust where there's mom, dad, and 2 kids as beneficiaries, each person can claim their own lifetime capital gains exemption when you sell that business. So you're looking at, if you have 2 parents, a couple of kids, 2 grandchildren, you could be looking at $10 million of exemptions rather than 1.25. So that's where it's become a real benefit for the people that have family trusts. And if you have a business and you might be thinking of selling it 10 years from now and you don't have a family trust, it's never too late to put one in place. But you do have to have it for a few years before it becomes beneficial. So for 2024, because of that capital gains inclusion rate that we heard about that's changing on June 25th, if you are actually selling your business in 2024, you should run through the numbers to see if it makes more sense for you to sell it before or after that date. It's not automatic because, you know, if you sell it before, you're still at that 50% inclusion, but you have the old lifetime capital gain exemption of just over $1 million. If you sell it after, you have a 2/3 inclusion rate, but you have the higher capital gains, the lifetime capital gains rate of 1.25. And when you're selling a business, it's not like selling a real estate transaction. You basically go to your lawyer and say, this is the date that it's effective. So you can change that date. So the Bill C2A transactions that I mentioned earlier, so those are still available. So they started in 2022. It basically allowed you to sell your corporation to your children. It's now been expanded to different members of your family as well. So they can use that transaction like I talked about at the beginning, whereas you would have sold your business to me. They can incorporate a company, they can have the debt inside the company, you can claim the lifetime capital gains exemption, the child has less cost, because if they have to borrow money, the interest is inside the corporation. The money to pay you for your corporation comes from the corporation. It's really opening up that transaction to the same as if you had sold it to a third party. So that's since 2022. The government really, like I said, they didn't really like that transaction because it did open up a number of loopholes for different people to do different things. So they've left it in place, but they have tightened the rules after 2023. So there's 2 different programs now. So for Bill C2A transactions, so you can actually choose to sell gradually or immediate. So and then there's different conditions for both. But in each case, what they really didn't like is that you could sell your business to the next generation and still maintain control of the business. So that has definitely changed for 2024. Whether you decide to go under the gradual or the immediate method, if you're using this transaction, you have to immediately turn over voting control of the corporation to the next generation. And for some family members that makes sense, but if you're turning it over to that 22-year-old, maybe that does not make sense. So each has to be considered on their own merits. And then the other thing that changed was the capital gains reserve. So before you could, you know, when you sell to a next generation or a next, you know, to the child or grandchild, there's really the child or grandchild doesn't have the big pool of money to come in and just pay out, right? So they allow people to claim the capital gains reserve over 5 years. So if it was more than the lifetime capital gains exemption, you know, you could spread that tax bill over 5 years. The new transactions after 2024, you can spread it out over 10 years. So it does lower your tax costs as well. Interestingly enough, I had a case right at the end of 2023 where we could have picked the date, you know, December 28, 23 or early in 2024. So we looked to see like which one would be better for that couple selling. And I thought, well, I immediately thought, well, it's gotta be better to claim the 10-year capital gains reserve because I'm gonna spread the tax over 10 years, it's gonna be less. Well, this couple was both over 65 and under that transaction, they had both lost their ability security for 10 years. So it actually became more expensive. So we dated it in 2023. But it's the tax calculations always have to be done just because sometimes you think that's the right answer, it's just not from a tax perspective. A little slide here basically just kind of summarizes, but again, you have to immediately transfer voting control, and then you have to transfer economic interest, you have to make sure you own nothing after 3 years or 10 years. Just a couple of different options. And when you have to physically step out of running the business. Although we had a discussion the other day, it's like how does Rugby Canada know when, you know, the founding person of the business has really stepped aside and not running things anymore? How are they going to audit that? So that brings us to the new program called the Canadian Entrepreneurs Incentive. So every person, like, so when you sell your business, if you're gonna qualify for the lifetime capital gains exemption, you may qualify for this Canadian Entrepreneurs Incentive. It's in addition, the conditions to qualify are stricter. So you first have to qualify for the lifetime capital gains exemption, and then look to see if you can qualify for this program as well. So the limit for each individual is $2 million. So if you think of the lifetime capital gains exemption, you have 1.25. This limit is $2 million. Now we're looking at somebody can sell their business and realize tax benefits on 3.25. It's a significant increase in the tax benefit for selling your business. So they're going to phase it in from 2025 to 2034 at $200,000 per year. So it's a really, really long phase-in of a benefit. So if you're one of those people that can sell their business in 2025 and qualify, and you've got this first 200,000, because it's 200,000 a year for 10 years, you might save an extra 36,000. So it's a good tax savings, but it's probably not to the area where you're gonna say, well, I have to sell my business now because I'm gonna save 36,000. But once it's fully phased in, like past 2034, the tax incentive is worth $356,000. So it's a very good tax savings for someone selling a business that can qualify. And this program is in addition to the lifetime capital gain exemption. So if you qualify for that and this, and it's past 2034, you're looking at the $356,000 of tax savings plus $416,000 of tax savings from the capital gains exemption. So very significant if you're selling your business after 2034 and qualify for both. So if you are thinking about selling your business and it is that long-term time frame for you, start planning about 5 years before. Make sure you maximize the value of your business. Make sure you get outside of all these rules. You definitely need 2 years for sure, but 5 years is ideal. A whole bunch of conditions come with qualifying for this program. It's more strict than the lifetime capital gains exemption, but first you have to meet that test, and they call that the QSBC test, qualified shares of a small business corporation. So it has to be a corporation that's in an active business. Can't be just holding investments. You have to actually be doing something. And then for, like I said, for 24 months, so there's that 2-year time frame you need. At least 50% of the assets have to be in active business. So if you do have something in your company that's not active, you know, like your investment portfolio, you have to get that out, and then 2 years later you can look at doing something like this. So this entrepreneur's incentive is for founding investors, which really hasn't been defined yet. Somebody goes into the example of, you know, the corporation that's set up, you know, is that person that subscribes for shares a month later for $100, are they a founding investor? Or is it just that first person that incorporated the company? But we'll see what the government comes out with the rules. So, but you do have to be a founding investor. So if you're that next generation that's selling for the second time, you're out of this condition. And then at all times, you have to have more than 10% of the votes in value of the company, which for a lot of people would be strictly they have 100%, or if they're with their spouse, they have 50%, so that's not a hard calculation to meet. But if there's multiple family members or a trust involved, then you have to look to see like what's the value of this company been every year since the person has owned those shares. That could be a difficult thing to calculate for some people. And then throughout when you're selling the company, if you look back 5 years, you have to have been involved on an active basis in running the company. And they use the same frame that they used for the TOSI rules that they came out with in 2017. So that to me means the same rules. So that's 20 hours a week working in the business. So you don't want to be retired and then selling the business 10 years from now. And then they limit it to a whole bunch of industries. So as an accountant, we're not surprised that they say professional corporations don't qualify. Because the government doesn't really seem to like professional corporations. So for sure, no accountants, no lawyers, no doctors. They also limited, so no real estate, no financial, no insurance, which again could be limited to that professional corporation or people that could incorporate. But then they add on food, accommodation, recreation, entertainment center, consulting, or personal care services. So that's, to me, that's a strange group of people to lump together. Like, if they don't like professional corporations and don't want an accountant to manipulate these rules, why would they take out a hotel? Why would they take out a restaurant? But these are the individuals that cannot qualify for this program. And that may change over time. Maybe the Canadian Federation of Independent Business will say this is not fair, and that, you know, get some of those industries back in the program. But think about who's left. One big one would be construction, engineering, people that generally don't sell shares of their business, they sell assets. And the last consideration is that people that are in this program have to obtain those shares for fair market value. So you go back to look to see what they paid for them at the original time. Just an example of somebody that maybe sold their business in 2025, and they actually can qualify for both programs. So what'll happen, so in my example, if somebody sells their business for 1.8 million of the shares of the business, first they would claim their $1.25 million of lifetime capital gains exemption, and then they would qualify for this program as well. So this $200,000 for 2025, so they would get that, and that means that it basically gets included at 1/3 rather than 2/3. So it's not an outright exemption like the lifetime capital gains exemption, but it's a lower tax treatment. And they're an individual, they get the first $250,000 at 1/2, and then anything else at 2/3. So before this rule, the tax cost of this transaction was $210,000, and after this rule, the tax cost is $138,000. And the longer this goes, the lower the tax cost will be, because you'll get more Canadian entrepreneurs incentive. And then on the agenda, Charlotte sent out when we first looked at making this presentation was other relevant tax matters. So I thought, what else is in there? And rather than maybe a way to like save money when you're selling the business or save money when you're selling assets, how about a couple of things where you can get money from the government? So there are a bunch of programs out there right now where you can, spend money and get money from the government, because they're very. If you listen to them talk on the news, they're very climate friendly and they're pushing a lot of climate programs. So we had a presentation to us a couple of weeks ago where they talked about different tax credits that people can get. One large one was solar. So there's tax credits for people putting solar panels on their roofs of their houses, on their businesses. At BDO, we have solar panels on our roof. We did this, I'm gonna guess now 20 years ago. It's been a long time. At the time we did it, we could write them off, but only to the extent that we had income. So if we made $5,000, we could write off $5,000, and it took us forever to write these things off. But now, if you put those solar panels on your roof, you get 100% immediate write-off, which is fantastic. There's lots of credits out there for clean energy. The big one I guess they're talking about lately is heat pumps. So if you're switching, so if you're making any kind of renovation into the HVAC system of your building, maybe reach out to see if you can qualify for some of these credits. And the other one that's really interesting is this, the charging stations. So you see they have this program running across Canada. When they phased it out first, it was all basically to the big businesses, like the Petrocans, like putting these charging stations. They want people to be able to drive their electric vehicles across the country and not worry about driving from Marathon to Wawa and not being able to charge, that kind of stuff. But now they are opening up that credit now to individuals and to businesses. So you could be a member of a condo association, and if you want to put an electric vehicle charging station in the parking lot of your condo, there's programs that can help with that. Same with your business. If you want to put it in the parking lot of your business for your employees to charge their vehicles during the day, there's programs that can help with that cost as well. They're run in, there's an application process, and here at Thunder Bay it's run by the CDEC, and on their website they list that the application is open until June 30th. So if someone's thinking about doing that this year, but then this goes to 2027 as well, so if not this year, because it's coming up pretty quick, maybe next year. Thank you.
We'll get you to hang here, hang there. Because I know there's gonna be questions. I hope you don't all feel like your heads are exploding, because I certainly do. But that's why we have these experts. So David and Jennifer are gonna answer your questions as best as they can. So John has a microphone. If you have a question, please raise your hand and he'll bring you the microphone. And our experts, it's Ask the Expert time. So who's first? Oh yeah, it's all clear. Everybody knows exactly what they're doing.
If you ask now, you get it for free.
Okay, well, perfect. John will bring you the microphone.
It's okay.
So we can all hear.
The question I have, So I've been at practice for 44 years, building things for clients over the years, and they have some substantial capital gains in different holdings, plus the business and that. But in saying that, is it, because we talked about that, like you've had your careers in this community. Am I okay for sound?
The people in the back might not hear.
Oh, sorry, okay.
Thank you.
So over the years, I've had different clients that have built their portfolios as well as assets building, etc. But the one thing we talk about is charitable donations. When you're delivering securities, not selling them. So it's a point in question either to your state or other structures, or in this situation. Does that improve or help to make that decision? Because the other thing we're talking about, okay, so this is going to go through. Then if you can make a capital gain selling something under the 250 personally, do you do that year by year? Haven't figured out that yet. The other one question, even last night at a session I had for clients, you're going to sell your cottage, and you got all your costs, outhouses, whatever there. Got to have the receipts, what you paid for it, if you rebuild it, everything you did over time. Perhaps you're in an apartment. Do you have, is it $9,000 a year of some kind of primary residence credit on your cottage? I don't know if that's there out there. But saying that again, see somebody wants to buy your cottage, $800,000. Can you do this? But there again, perhaps not. You've changed the name. If they give you $250 a year, but no, you've changed the name. The last out of office, it's happened then, so that doesn't help. So. With donations, would it help at that point if they wish to? And was there a limit of donations?
Can we stick to one question at a time, Jacob?
Okay, go ahead.
Just to start with the first round of.
Yeah, I mean, are you talking about donating?
Where's the
Sorry.
microphone?
Are you talking about donating listed like securities?
Yep.
Like securities?
Viable securities that they don't
Yeah.
have
So the
cash
inclusion
in.
rate is still 0% on that. So you wouldn't be taxed on those.
But you're taking that credit
Yeah.
to knock down the capital gain.
Yes. So, I mean, you'd have to go through the math and see.
Yeah.
I mean, it would be a pretty, it's a case specific question, but you definitely just run some numbers and determine if that makes sense or not.
To help them when they're over the 250.
Yeah, yeah.
Thank you.
Okay.
That question of principal residence comes up a lot in Thunder Bay, right? A lot of people have houses and camps, so they're always looking, when they sell their camp or transfer their camp to the, put the kid, change it from mom to kid on title, you basically have a sale at the same time. So what mostly happens in this city is people claim their principal residence exemption on their camp if they can, because those have the higher capital gains. And I always, my advice to people is like, claim that residence, that principal residence exemption for when you sell that first property, unless you're selling them one this year, one next year. Because you don't know 5 years from now if that exemption is still going to be here. So, but for most people selling their camp, they claim the principal residence exemption.
Do you have to do that? I've had 4 homes, paid them off. So
Yeah.
you have to do that right away in the last one you sold to make it so, or can you go back to claim?
You're allowed one per year, right? So if you sold a house 5 years ago and you didn't pay any tax, then you'd use the principal residence exemption for those years. So you have to look back at the history of each individual's properties.
The last home, not the others.
The last home for sure,
Yeah.
yeah.
Michael? Stina? John will bring you the microphone just so everybody can hear.
So you recommended setting up a trust fund that would be the benefit. Can you go over the trust funds? Because I'm looking at maybe say for trust funds, would that be more tax? It's beneficial for my children.
There's a couple of different, there's different kinds of trusts. So if you're looking at a trust fund where you basically just take money and put it in the bank and you say this is in trust for a certain person, that's different than what I was talking about. I'm talking about a specific, it's called an inter vivos trust, where you basically set up a trust, you have trustees, the trust actually subscribes for shares of your business, and then it holds shares of that business for multiple years as it grows in value. So it's different than just a trust fund, if that makes any sense.
Yeah.
Josh Niagarwal? Hopefully the microphone works.
Hi, yes, it is working, sorry. Okay, in my real world, there's a lot of aging families that have investments as real estate. They've asked me if they should sell their investments prior to the 25th, because their kids are sort of thinking about taking over, but not. These investments are held in holding companies. Are they gonna be taxed at the same rates? Do the same rules apply?
Yeah, so holding company, it would be under the corporate rules. So if you are doing that, then any capital gains after June 25th would be the 2/3 inclusion rate. Anything prior would be the 50% inclusion rate. But then you also gotta look at, is this holding company associated with any other active business? Because if they are associated, then those investment income rules, without talking about, we're over that 50% threshold, or $50,000 threshold, that could grind down the small business deduction rate of your active business if you're associated.
And if they decide not to sell it because the exemption rules change, should, and I think it was 1994 when everyone had to get values on their camps or cottages, and that was the baseline, and then anything after that was taxed? Or,
Yeah.
is there a benefit to them to get a baseline prior to the 25th of June, or not?
At this point, we don't know because we haven't seen any legislation and what it's gonna look like. So right now, that's too hard to answer because we don't know that.
Wow, so it's gonna be a lot of rush at the 11th hour for everybody. Okay,
Possibly,
thank
yeah.
you.
While you ruminate on some other questions, I always have questions. So my question, there's been a lot of, well, certainly the Chamber of Commerce and many other business groups have been talking about how these changes will impact the investment climate in Canada. And I wondered if you have any thoughts on how this is comparable to perhaps what the rules might be in the US, where folks might choose to move corporations to the US because tax rules are more favorable or less favorable. Anybody want to take that on as to how this is going to make us competitive or less competitive?
I'm closer to the mic. Reading an article this morning, 126,000 people left Canada for the US last year. That's a significant amount of people. For businesses themselves, yeah, the rate environment is not good. The Canadian dollar is not good. The interest rates are extremely high in Canada, so the cost of borrowing is kind of terrible. But we see a few different projects around the city that are going to making the city economy not too bad. But you hear lots of stories in the bigger centers where projects are scrapped, and just because the interest rate is just too high to grow. Never mind the increase on the capital gains tax when you sell the property. So it's not a good combination to have.
David, do you want to add anything? He looks like he's a little nervous about getting in there. Go for it.
No, yeah, I mean, it's a tough question to answer. I guess we don't really know what the impact's going to be until we see it play out. And you're right, it could have an adverse impact on the Canadian economy, but again, we won't know that until it kind of plays out a little more.
Is there not an emotional attachment to that? Sorry. Clance and I have been talking about it, and I talked to another accountant, a fellow I've known for some years. An emotional attachment to Canadian citizenship, you're still getting your CPP, okay, fine, forget the OAS. Anyway, do you not have to stay outside Canada 6 months and so many weeks?
I mean, the international tax rules, they are quite complex. There are different ways that you can become a non-resident of Canada for tax purposes. It's not always just the days that you spend in another country. It has to do with where your property is, where your family is, where your home is, where your bank accounts are, etc. So I mean, it's a quite complex tax situation. And even moving from Canada to the U.S. or U.S. to Canada or wherever Canada to anywhere, there's a lot of work involved to have that complete. You definitely need to reach out to an international tax expert when you're dealing with anything like that. But there's a lot of work involved for that.
Last call. Okay, these two deserve a huge round of applause for and you can talk to your senior partners who volunteered you and, hold it over them for hopefully some positives for you in the future. So thank you so much. I also wanted to thank Evan Neufeld from MNP, who really did a lot of the heavy lifting to bring two firms together, putting together their messaging to make this all look so smooth. So thank you, Evan. I really appreciate your help on that. I guess the thing that I'm taking away is please call a tax expert. Don't think that you know what is the right thing to do, because it could hurt you later on. And we do have some amazing tax experts within the membership, and so please definitely do that. And I think that any tax expert knows that they're going to be kind of busy for the next little while, so clear your schedules, folks. I want to say thanks to everybody for coming this morning. Also want to thank the Prince Arthur Waterfront Hotel for a great breakfast and hosting us this morning. And before I let you go back to your job, of course, I have to do a chamber infomercial. So we do have some upcoming events. On June 4th, we have our Leaders Lunch. That's Tuesday, if you can believe June is next week. Leaders Lunch with the President and CEO of the Forest Products Association of Canada, Derek Niver. He's going to talk about the importance of a successful forest industry in building a stronger and more resilient rural economy in Canada, and the importance of that rural economy to the full country. So don't miss that. Friday, June 7th, which is next Friday, we're hosting the second part of our professional development series, Greatest Habits of All Time, with 3 TED Talk style presentations that will inform and inspire you on your leadership journey. And then on June the 19th, we have our member social with the Lake Superior Scottish Regiment at the Armory on Park Avenue. So a great chance to get a sneak peek inside the armories and find out what they're doing, and how you can work with them to maybe get some cadets or things to help out as well. Also, final reminder, if you're a beer lover, Brewha is just about a month away, July 5th and 6th. Tickets are still on sale, so don't forget to get your tickets, and we hope to see you all at Brewha. So thanks to everybody for being here this morning. I hope this has been helpful to give you some stuff to think about, but definitely encourage you to talk to your advisors to get the best solution for your individual situation. Have a wonderful day, and we'll see you soon.
Yeah.